All right, welcome back and thank you for joining us and sticking with us. And with me is Ken Gishinga. He's still here. We are talking. Now we want to change the conversation a bit and talk about bonds. And to lead us into this conversation, I would want us to read something that came up this week also. Kenya flirts with 17% interest on 5-year paper. And to also explain this even more, Treasury is increasingly taking costlier loans from the domestic market as investors asked for 16.8% return on 5-year paper. And also CBK says it raised 38.6 billion shillings from July's bond auction, falling slightly shy of its 40 billion target. Now to discuss this even more is Ken Gishinga. When you hear something like this, what does this mean, first of all?
Oh, it's a bit worrying because anytime interest rates are rising and inflation is falling, it means you have a disconnect. And anytime government bonds are the best investment class, which they have been this year, there's also a problem because typically government bonds should be the lowest risks and should have the lowest return. So when you have bonds, when you're flirting with 17%, it tells you that why would you want to invest in real estate? Or do you want to invest in any other business except lending? So it tells you that huge government borrowing runs the risk of draining money from the economy, money that could have gone to the private sector. And that's what we call the crowding out effect. So it presents a real risk to businesses, and that's why you feel many businesses are having a cash crunch.
Yes.
Because a lot of the money is going towards these bonds.
All right, even before we continue with the conversation, let's go back a bit and look at bonds. When you talk about government bonds, what do we mean?
Well, government bonds or gilts in some countries in the Commonwealth represent a debt instrument. So historically, every once in a while, you'd find government needs to spend more than the revenue. Historically, that came up during wars when a certain country was waging war on another country and they needed the ammunition. So they would go and borrow. And one way that government borrows is issuing a bond. So a bond is a debt instrument that the government uses to raise money. And it can also be an investment opportunity for an investor. So if you have a bit of spare change and you can put money and you're looking for a good risk-free return, it can be an avenue. I think the problem we have in Kenya is the interest rates are too high. So government is servicing very expensive debt. So a lot of people say, well, that's a good thing for investors, but even investors know when something is too good to be true, there's something possibly wrong. So I think as investors are buying these bonds, some of them are also wondering, will their government have the revenue to be able to pay these bonds when they mature? So that's becoming an increasing concern among the investment community.
All right. And also, I think we'll get now to the investors. But before we get even to the investors, let us look at the importance of government bonds and how it enables government to operate.
Yes, indeed. So, as I said, traditionally, governments used to borrow for emergencies. Maybe you have a pandemic or you have a war. But as years passed on, governments ended up spending on other things. Maybe you can say in Kenya we have an infrastructure gap, so we need to borrow more to be able to build more roads, which can build the more the Kenyan economy, which is a very fair argument. Kenya does have an infrastructure gap, and you do need those infrastructure bonds do help. I think the challenge has crept up over time when this has sort of stopped becoming what you'd call a once-in-a-while phenomenon to almost a recurrent expenditure, recurrent debt. And as you've seen over the last 10 years, government borrowing has increased by a factor of almost 4 and such. So we are starting to forget that the purpose of debt was to deal with emergencies, things like COVID, pandemics, but we've sort of internalized debt in a way that even now governments have borrowing targets. It's almost as if now you've internalized. So even the idea of a surplus the government should run surpluses stops being an option. And this government has run a surplus back in 2003. So I think it's again, government dominating the economy and needing to borrow more to do more things for the economy. But what really drives an economy is the private sector. So when that money is being drained and going into government projects, it means the private sector now has less and less money to do the things that private sectors do. Now that is now what we call the crowding out effect that we are seeing right now.
All right, and also now let's move to the investors. An investor sees the 17% interest. What does this tell them? Is it something that motivates them even farther away from even doing the sort of business with us, or what is it? What does it speak to an investor?
Well, the biggest investors in these instruments tend to be commercial banks and pension funds. And for them, this is an avenue to park money and get risk-free return, because government bonds have that risk-free status. So an investor such as a pension fund, particularly in an economy that's clouded with mandamanos, where the business environment is very tricky, you might say, I don't want to buy stocks because all these stocks are tied to what's happening in the economy. If you're a bank, you might say, I don't want to lend to businesses. Look at these businesses that the windows are being smashed. Are these businesses, will they be able to pay us back? So you find fund managers who have that mindset that if the business environment is not good, why lend to those entities when you can park your money in government bonds and get risk-free return? The challenge you have in Kenya, because in many other countries, government bonds give you the least returns. If you go to the United States, it's only right now that the 10-year bond has crossed 4%. It's always been traditionally under 3%. So it tends to be the lowest returns. But in Kenya now, it tends to give you the highest return. So not only are you getting risk-free status, but also you're getting the highest possible return that you'd get, even much better than lending to the business. And that's sort of like the disconnect that we have in the Kenyan economy, that what we call in finance, the risk return. You know, the lower the risk, the lower the return, the higher the risk, the higher the return. That equation has been broken. So you have elements that have low risk but have the highest return. And that really complicates the investment thesis for a lot of people.
All right. And also, even as you speak about the investment thesis now, someone might be saying, okay, the 17%, that is not going to, how will it affect me individually? What does this mean for me, who is a citizen of Kenya, doing my own business, doing my own things? How does this affect an individual Kenyan?
The way it will affect you is, as government issues these bonds, it will need to pay them back, because bonds mature and they have to be paid off. So what that means is the government will prioritize paying off those bonds, as opposed to paying, if you're a supplier, let's say you're a contractor who was in charge of building Mombasa Road out here. In the pecking order of being paid, you'd be much lower. The government would say, the revenue we've collected, we need to first pay off the bonds. We need to sort out our debt issues. The little that's remaining, yes, we'll pay you, the contractor, we will pay the health people, we'll pay salaries. So you come towards the very end. So that leads to what we saw in March and April, where civil servants went without salaries. Not because the government doesn't have money, but because the priority has been to service that debt. So anytime you go to maybe a hospital and you can't find drugs, and the hospital tells you they haven't gotten funding, or when you see governors on TV saying they have not yet received funding from the national government, or security-wise, when the police station around you, they tell you we don't have enough cars to come. So it hits you from morning to evening in very different ways. So anytime you feel there's a cash crunch, even in the private sector, even in a media house like this, is money owed by the government. So it means delays for employees
and
such. So that's how it affects you as an ordinary Kenyan.
Okay, thank you so much for that. And now let's also move on and overseas. Look at you've spoken about the United States and inflation in the US and also the currency. Let us first of all start with the inflation, and because of course anything that happens with the US inflation, the shilling, the currency going down or going up affects us as a country. So let us first of all start with the inflation. What is happening in the US?
Well, this year inflation has been a problem in the US, but it has been coming down. At some point, it was approaching double digits. The numbers that came out yesterday were about 3%. The US normally has an inflation target of 2%. So it has been coming down, but it's still above the 2% target. Now, markets took that positively. Markets saw that because inflation is coming down, the risk of the Fed increasing interest rates further reduces, because that is what the Fed has been doing. It has, over the last 1.5 years, been increasing interest rates, which has made the cost of life very, very difficult in the US. Now, when those numbers came down at 3%, global markets were very positive. They said, okay, this means the end of higher interest rates is in the horizon. So this means that the Fed might not. There's a 25% chance, I mean, there's still a possibility they'll raise interest rates because 3% is above 2%. But a lot of people are saying the days of further interest rate hikes are actually coming down. What does that mean for the currencies? It means the dollar rally that we've seen might come to an end, which means from our perspective as Kenyans, it's a sigh of fresh air, because that dollar rally is what has put us today at 141.
Yes, 141.
141. So I think from a currency perspective, it's good news. And you're seeing global markets are reacting positively, and we might see that stronger dollar sort of like stabilizing a bit. Yeah.
And when the stronger dollar stabilizes, what does this mean for Kenya? The exports, the imports. What does it look like when now the dollar is stable?
When the dollar is stable, it means our shilling we might not see the shilling slide further, which is good for importers, because if you're importing things and your shilling weakens, it becomes very expensive. If you're importing medicine or drugs or food, anytime the shilling weakens, it becomes more expensive. It's also good for our debt profile, because we have a lot of foreign debt, and anytime the shilling slides, the foreign debt becomes more expensive. What it's not good for is exporters. The people who have been really enjoying life are exporters, because they get paid in dollars. So the dollar that was 120, now it's 140.
Yes.
So you can imagine how much more you can do if you earn your salary in dollars, or if your services are paid in dollars. So those might be the people who might not look at this news in a favorable light, because they have had a good time.
All right. Even as we look at this situation in the US, trying to look at this now, even by December this year, what are we looking at in terms of trying to, for the importers, the way you've explained, because the shilling is where it is, the dollar is where it is. What are we looking at in terms of the importers who, by the end of the year, and maybe we say it's stable, what are we looking at in terms of them making profit?
Well, the way you think about it from an econometrics perspective is you look at, again, in the US, you say inflation is at 3%. Chances are the Fed might increase interest rates just maybe one more time. So you factor in maybe one last dollar strengthening before things stabilize. What does that mean? Maybe now we're at 141. Further dollar strengthening maybe might take us to maybe 148, 149. But then after that, you find now we might get a new equilibrium of sorts. So if you are an importer, of course you do want to buy things now, because they will be cheaper now when it's 141 than it's 149. So if you are buying your used cars or importing textbooks, this might be a good time, as opposed to 6 months down the road where you might have to buy those dollars at 150, for example. If you are an exporter, it's the different story. It's almost the reverse right now.
All right, let us now close our conversation on that story about the US and also the shilling and also the dollar. Also, let's come back home and look at gas prices. We did a spot check this week and we saw some areas had reduced. The 6 kg is at 300 shillings and also the 13 kg is at 700 shillings. And this is following the directive on not taxing on is it LPG?
Correct.
Yes. So what does this mean going forward? Are we looking at us going back to where we were, where the prices were a little bit manageable? And what does this mean now going forward for even a gas company, that a company that distributes these gases to Kenyans?
You know, for every household right now in Nyakundi, every shilling counts. So every shilling saved is a reprieve for those households, because many households today are operating on really a wing and a prayer.
Yes.
And for such households, this is welcome news, that the fact that their shilling can go further. So given that the current mandamano has been framed on the cost of living, I mean, there are other issues, but that's sort of been the central issue. I think this should be able to provide some reprieve. Whether it changes the complete household budget, absolutely not. I think the issues of VAT on fuel are still big, but I think it goes a long way in providing that relief. Yeah.
All right, even as we wrap up now this conversation going forward, Ken, from where you sit as an economist, when you look at Maandamano Wednesday, now next week is going to be Wednesday, Thursday, and Friday. What does this have to? When you a leader of the country, or if the president of the country is watching the Maandamano, what does this speak to them as a leader? And what are we looking at in terms of the businesses that we have? A person who has just started a business maybe 3 months ago, or when the year started, going forward, from an economist perspective, what are we looking at in terms of businesses in the country, and what can the leaders do in order for us at least to salvage the little that is left?
I think it's to remind the leaders that stability is the underpinning of a good economy. Investors and investment confidence comes from countries that have stability. And that's why Kenya has enjoyed foreign direct investment way above the region. And remember, we're in the Horn of Africa, where almost every other country around us is having some problems. So Kenya has been a beacon of stability, a beacon of peace. A lot of Kenyan foreign multinationals choose Kenya to be able to serve the region. So we also have to remember that people in Ethiopia, in Sudan, in Somalia, they need Kenya to be stable, because a lot of these NGOs that are serving them have their bases here. So it's not just a responsibility. Stability is not just a responsibility for us Kenyans, but you also have to think of the African responsibility we have, where you have so many fragile states that badly need Kenya as an island of peace and stability. And I think that should be able to be the motivating factor to bring them together, to give us that stability.
Okay. All right. Thank you so much, Ken, for joining us. And the stability that you're talking about, I believe the leaders need to just sit down and at least bring the country back to a trajectory where we are looking at trying to improve ourselves. Right.